So when you restarted the construction process, I think maybe there's a construction loan in 2012, somewhere around there, maybe
Yeah.
resumed? Okay. What was in your eyes, the vision for that project? Like, as far as due diligence, how did you perceive the need or desire for this type of luxury condo product down near Wall Street?
Well, it was like it always is. It was a head scratch. We noticed that across the street from the building was a large development called Battery Park City, and pricing in Battery Park City was $1,200 or $1,300 a square foot for the buildings that were condos. They were called condos, but this was a sleight of hand by our government. They were actually built on a land lease.
Wow.
And in New York State, if you're anybody but the government and you build on a land lease, you have to call it a land lease co-op.
But they didn't have to.
But if you're the government, you get to call it a condo, which of course it wasn't, but according to New York State it was.
Funny how that works.
Yeah, funny how that works. But it was very important that what we figured out when you really got into the subtlety of it was that the land lease payments represented another $300, let's say, in value. So on a more equitable comp basis, we were really up close to $1,600, and that was kind of our bet going in. We needed to get to that pricing in order to have a decent margin and make the project viable. And if you looked at it superficially, you'd say, well, it's not $1,300, you can't.
Of course.
But that wasn't the case when you really went into the detail. And the other thing that our development department had carefully charted was the recovery after 2008. Like so many low times, what happens is, of course, there's no new inventory being built.
That's a good point.
So everybody's kind of frozen, and demand starts to rebuild, and whatever surplus supply there was at the beginning of the crisis gets absorbed, and then suddenly you have a new crisis. There's a shortage of supply, right. And we could see those lines on our charts crossing in 2012. So it became a very pivotal time, and we were able to bring all of this data to our bankers and convince them that this was an opportune moment, and then we started up again. You know.
Wow. What was it looks good on paper, the pro forma looks good, but executing obviously is the next part in the process. So what was the sales and marketing process of that? I don't know what the strategy was, but what was the strategy, and how early on did it take where you're like, okay, these are being absorbed, or like we're finally getting forward here?
So we started really right off the bat once we decided to move forward. We began pre-sales, and we found a very nice office that was a half a block away from the site that had the same view that people from the apartments from the new building would have. And that was really critical, and it's one of the things you do when you're building a project. Locating a sales office can often be critical in order to deliver the experience that you're trying to sell on a pre-construction basis. So we set up a great sales office, and of course you amenitize, you put in all the sort of finishes, and you make it as close to the experience that people might have in the building, so they get the feeling for it. And you begin trying to convince people to agree to buy apartments pre-construction, and then later during construction, because obviously you'd like to have as many units sold when you finally complete the building. And so that went well, and we were our sales were very strong.
Wow.
And so much so that we were able to increase prices
Through the sales cycle.
during the sales cycle, which is a good thing because what motivates people sometimes when they were in this yesterday looking at a plan and we're legitimately a month later or 2 months later, prices change.
Right.
And they see that sales are occurring, so they know the people who got in the beginning made a good deal. So I don't know how many price changes we had during the sales period over 18 months or whatever it was, but we had quite a number of them that were legitimate because we kept selling at those higher prices and sort of building the momentum.
For those pre-sales, you were taking 10% deposits or larger?
Yeah,
okay.
10%.
What was the part in the project where if you read the book, it's well documented in there, but the amount of pain and holding on to that $500 million project for a long time, paying interest over all those years. At what point did you feel like, okay, we're breathing again? Like, was it during the pre-sales or was it until they actually closed and construction was complete? Where did you feel like, all right, hey, there might be some light here?
Well, of course, when that interim period between 2008 and 2012, we still had a loan on part of the land value and on the foundation and all the plans and that had gone into it. And I forget the amount of that loan exactly, but it was probably 30 million, 40 million. It wasn't a nickel. And we're carrying that at, whatever the interest rate was at the time, plus the taxes. We were shelling out $3-4 million a year while we were staring at an empty mud hole.
Yeah. It's expensive mud puddle. Yeah.
Mud hole, which, insult to injury, we even had to have guards, because it's the city requirement, making sure that nobody fell in the mud hole.
Oh,
I mean, it was all fenced in, of
Right.
course, and
Yeah.
protected, but, the city has tough regulations about unbuilt sites. Anyway, so once we got into construction mode, that was a relief, because rather than it coming out of my pocket, it was coming out of the development budget that was built. It was built in to the reserves. So that was a sense of relief. But of course, if we weren't going to sell the project successfully, the banks would be knocking heavily at my door, and the kind of loan that we had required personal responsibility. So they would be knocking very loudly.
Yeah.
So the next sense of relief, of course, was when we started making those sales. And then also as part of our capital stack, we had some very pretty expensive preferred equity from a major hedge fund. And so I was very much looking forward to the day when we would be able to pay them back, which of course didn't happen until the building was finished and we started closing. But we had ranked up enough sales to pay off first the first mortgage and then that preferred equity loan.
How long did it take? What was the sellout process? Like when was it set up on like a takedown schedule where like the debt was going to be done after 70% of the units, or how did sales take care of
the
debt
debt, as I recall, on that project, the numbers are, I think the debt represented about 60% of the cost.
Okay.
Or maybe 50 or 60, I can't remember.
Mm-hmm.
And then the preferred equity probably brought it up into the 70s.
Got it.
And the rest was our own equity. But that was of the cost. Obviously, you're trying to sell for more than your cost.
Yeah.
So probably we paid off the first mortgage with 40% of the sales, or
Okay, wow.
something like that, 40 or 45%, and then, another X percent to get the preferred paid off. We ended up selling about 70% of the building. And then the market slowed. And we had always had a plan that we were going to hold on to a certain number of units, because if you rent units for at least 2 years and then sell them, you get a different tax treatment than if you sell them right away. In one case, it's capital gain. In the other case, it's regular income. So that was a significant difference for us. We probably would have originally sold it up to, maybe we would have held the last 20 or 25% of the units. But somehow the market started losing steam, and we ended up at about 70. And so we just decided, okay, we'll hold there.
Okay.
And we decided to rent the units, which we did. And the rental market was, even though the condo market was running out of steam, the rental market was red hot.
Wow.
And so we got extraordinary rents for the apartments in the building, probably ranging from, for a small one bedroom, maybe $7,500 a month, all the way up to, I think the penthouse rented for $60,000 a month.
Wow.
And everything in between.
Okay.
So, and essentially, for what we've kept that inventory of apartments, we sell them occasionally when sometimes somebody we rented to wants to buy one.
Sure.
We haven't been very aggressive about our sales program. We've basically been taking the rental income, and those rents have gone up significantly since the beginning. And so we sell an apartment when there's somebody wants it. But mostly we've been happy to rent them.
Wow. What year was that where that plan changed, where you hit 70% and then started to get into the rental?
Gosh. I'm thinking 2017.
Okay.
Something like that.
The reason I ask, I think this can be a good transition point to 1000M, which I think you acquired the site in 2016. So
Yep.
maybe somewhere around there. So to wrap on 50 West as a precursor, having sweat that deal out for considerable amount of time, but also having a lifelong relationships in condos and co-ops, but this being a new product for you, being this luxury skyscraper, what were your takeaways, or where was your appetite to do something like this again as you make it through some of those sales?
Well, as I think about takeaways, one of the takeaways are when you take on these projects, you have to be flexible and be prepared to adjust your business plan constantly as the environment changes. These plans take 5 years is short, 10
That's
years
right.
is not unusual, and a lot changes, good and bad. And if you're going to survive in this business, you have to adjust to those changes,
Right.
particularly the negative ones. The positive ones, you can
Easy to
just
adjust
smile
to,
and. I always say, if it's bad news, call me 24/7. If it's good news, you can send it by snail mail.
Benefit Street Partners had gotten to build up some steam. It took them 4 or so years to do it, and built out strategies that went far beyond that original, distressed bridge loan business, and built out a direct lending business and a liquid credit business in bonds and loans.
So they had those three strategies at the time, and they were, from what I read, somewhere around $3.5 billion or 3.4.
That's right.
$80 billion today. It's a big difference, and that's over what, 12 years there. So what is then the growth journey when you come in, and did you step in right away as president, or was there another role you were in when you joined?
No, I stepped in as president, and I am quick. And I'm glad we can share this with all your viewers to point out that we went from 3.4 billion to 80 billion.
It's crazy.
While I was there. But my partners are quick to point out that if you read anything about starting a business, the first 3 billion is the hardest, right?
That's right. Yeah.
Most firms don't even make it to that. They
course.
don't last that long. They did the hard part. Was their
Starting
point.
it. Yeah.
But no, it was an incredible journey. I started, and my role, in the beginning was, and maybe even to today, was strategic, thinking about strategic directions for the firm, what strategies to undertake, M&A. We made a number of acquisitions. I think the most successful firms, you look at the Blackstones, Apollos, all these firms that have been successful, they've succeeded because they're really good at what they do, but they also filled in with acquisitions, oftentimes because they have inexpensive currency to buy other things because they have high valued stocks and stuff. And we did the same. We made some key acquisitions. We built out a permanent capital part of our platform we have a BDC. It's I think the 7th largest BDC. We have a publicly traded commercial mortgage REIT. If we're going to talk about real estate, we'll talk about FBRT, our commercial mortgage REIT. So some of that stuff we built out by acquisition. But, my role is more strategic, M&A, fundraising, and, generally running a business.
What do you think what were the biggest acquisitions or most pivotal acquisitions in building the company and bridging that delta of 77 billion there to where it is today?
I know you don't have a 5-hour podcast, so I'll try to keep my answer short, but this is a really good story, another good story. I'll give you the short version.
No, you take your time.
So the best by far is buying the one I said, the BDC and a mortgage REIT. So there was a manager called American Realty Capital. They were the biggest and best by far in the retail channel of raising capital. They called them non-traded REITs. Their specialty was real estate, was REITs, and they had built out some monster. I mean, they were the best. But they had gotten into some legal issues at the parent company, and we approached them and said, listen, you have a BDC, which you raised, but BDC, I know that's not really your business. I know, how good you are in real estate, but not really. Would you consider selling that to us? And anyway, one thing led to another. It took a long time to find the price and negotiate the deal. We negotiated a deal, and that became our BDC today. We grew it. We turned over the investments multiple times and merged it with a sister BDC that we had raised. So we parlayed that into something much bigger. But you needed that snowball to start getting down the hill in that acquisition. But the best part of the story was, while we were negotiating, it took months because BDCs are regulated under the Securities Act of 1940, and the voting requirements to get those proxies just take forever. REITs, for example, are way quicker. And they had a REIT. They had all these property REITs, or net lease REITs, but they had this one REIT was a commercial mortgage REIT. It was called RFT, Realty Finance Trust, and it was small. It was $700 million. For them, that was small.
Was it a new product for them?
It was.
Or
it
just
was.
Something that
it was a
didn't grow?
REIT that they had raised. The way their capital raising goes, yes, it was new in that they had never done a mortgage REIT before.
Right.
But they got it up to $600-700 million of capital raise, and then they had these legal issues. And the way the curve works for raising capital is, you spend 2-3 years getting all the selling agreements and stuff, and then in that last 2 quarters, 5-6 months, you raise all the capital.
Right.
So they didn't get to that last part yet. They got to 700. They probably would have gotten it to $1.5 billion or $2 billion. It was sort of stillborn. 700 still acceptable size, but it wasn't what they had wanted. And but it's in the real estate category, but it's a mortgage REIT. They never did lending before. They did property REITs. So I had always said, RFT, if you want, we could buy that too. No, we'd never sell that. We'd never sell it. So anyway, long story short, one of their lenders pulled their credit line. and it was in distress.
Okay.
And I'll never forget, I was out paddleboarding one day, and like once a summer, you get the ocean is flat enough
Sure.
that you can take because I'm not that good, and you take the paddleboard out, and I accidentally left my phone on. I was listening to music or something, and it was them calling and said, if you were serious about buying RFT, we'll sell it to you. Are you still interested? Yes. Was the price you're willing to pay still the price? Yes. Okay, sold.
Wow.
That's how we got that done. And that turned out to be, that was a $600 and something million commercial mortgage REIT. It is now $6 billion.
Wow.
And the fourth largest publicly traded commercial mortgage REIT.
Wow. Getting back to the more trophy assets, so to speak, with these challenging products where there is nothing here, like this is a good example, maybe it was vacant. How hard or what is the structure of financing these deals or getting capital?
Oh, they're really hard.
Yeah.
That's, going back to what we
you gotta
talked about
sell
a
the
little bit,
story
that I
of-
spend a fair amount of time on capital raising. When we did Ponce, this was very much a pioneering location. Some of the most well-respected people in Atlanta real estate basically said to me, that is crazy. Like, no office tenant or serious group would ever want to be in that unsafe neighborhood. When we did our first big office tenant here, and we knew we were looking for unique tenants. This is a true story. One of our first office tenants here was a company called Athena that was located, their headquarters is outside of Cambridge, Mass. They had a small presence in the Atlanta suburbs, and they wanted to have a major Atlanta presence. They wanted to really grow almost a second headquarters. And their senior leadership came in town and was looking around at different buildings. And finally said to their broker after a day, everything here is really boring. I come from Cambridge, Mass. We're in an old munitions factory. Why is there nothing interesting here? And the broker said, well, there's this one project that's under construction, redevelopment, called Ponce City Market, but it's really unsafe, and I don't know if I feel comfortable taking you there. True story. And he said, I'd like to see it. And they called the broker called me, and good news, I was in town. And so I go down there, and I'm barely able to make the tour. This place is totally under construction. We're wearing hard hats. It's a total chaos. And we can't begin to be ready. And we're walking through this old building with the hardwood floors and total chaos. And in front of me, the CEO of Athena turns to his broker and says, I don't know why you showed me all this crap. I'm only doing this deal if I can office here. Now, that'll be a high point of my career. I could do this another 10, 15 years, and I won't have a better meeting than that. But it's this was a pioneering location, and that's a hard story at times to tell. We're looking at a deal right now that in a Sunbelt city that I already know a lot of people are saying, isn't that a little too pioneering? And our experience, though, has been people embrace these sort of environments.
Right. So when you're leasing that, or Athena, who I think maybe still here.
They still have a presence here, okay. Yes.
You had already purchased the property, I assume, by that point. So what is is it hard to get debt, or is it a lot of preferred equity?
It's really hard. Our capital structures on deals like this, we've been very fortunate. We've had a committed group of shareholders and investors who believed in us and our vision for creating value. But these are not your traditional deals, and they're very hard to finance. We had a lot of equity. Before we could get a loan at Ponce City Market, we had probably invested $150 million of capital. And so it's a pretty unique thing to have that good fortune that you can spend $150 million roughly of equity before you can go get debt.
No kidding. Wow. Can we talk about One Times Square? So you have some really exciting stuff going on there, but it is maybe one of the most iconic assets in the world, obviously. So it is the building that everyone sees with billboards all around it. What was you like to buy deals that are value add? What was the challenge that it was having in '97? Like, how did the team buy that property originally?
We just believed it was a really unique asset. It was one of the first big Jamestown deals I worked on. We believed that it was unique as a signage opportunity. You know, there was a Walgreens on the ground floor, but most of the building was vacant. It was basically a pylon sign. And we believed it was so unique that there was upside in signage opportunities, and that over time, back then, those were traditional canvas signs.
Right.
They weren't digital.
Of course.
And we believed over time you could go to digital signage, which would allow you to break it up in, you know, we didn't necessarily think you'd ever be able to break it up in 30-second intervals.
Sure.
But back then, you know, we were doing 10-year leases. And so we always thought over time you could go to shorter term deals with digital. And that it was really unique, and that the building had worldwide value. I mean, when there's a snowstorm in New York City and they show somebody cross-country skiing down Broadway in a newspaper in China, and they're trying to make the point about how much snow fell in Times Square, they show somebody cross-country skiing down Broadway with one Times Square in the background. And the signage. And that's part of the opportunity that we believed in at the time.
Wow. And then as it's evolved, your hypothesis being correct, heavily digital now, all digital. But it seems like there's, from what I read, a $500 million redevelopment initiative. And there's maybe an observation deck with some proposal and wedding area as well. But it seems like, maybe I read a Wall Street Journal article at some point where they talked about the Empire State Building's most valuable per square foot place in New York City is the observation deck.
Empire State Building, I don't want to get my facts wrong, but an incredible high percentage, call it 15-20% of the revenue comes from a small percentage of the square footage, the roof. Right. Yeah. And for the longest time, One Times Square was basically a Walgreens on the ground floor and signage. And the simple story is we're effectuating a repositioning that's going to value the interior of the building and the roof opportunity. And we're doing everything from a wedding venue in partnership with New York City. We're doing a History at Times Square museum. We're doing an observatory. We're doing experiential retail, brands, telling their story inside the building, potentially music inside the, various, almost call it digital concerts, if you will, and taking these strides to turn the building into a 21st century asset. The building, yes, the signage revenue grew over time, but it was basically a 20th century asset. And so we're taking steps now to bring it into the 21st century. It's incredibly exciting. And we feel like we're putting all the ducks in a row and getting everything right, but it's very complex.
I was going to ask next, how challenging is it doing construction or putting plans together, let alone in New York City, which is very challenging to do, but in an asset that's so heavily foot trafficked, what are the complexities of rolling out this renovation and rebrand?
It's always so difficult in New York City because, you're always going to get millions of people walking down Broadway. And so any construction in New York City comes with more complexity probably than anywhere else in America. But we have a great construction and development team that's executing fantastically. And, we hope to CO here in the next few months.